And so you might get a situation a bit like, the kind of mid to late 80s where interest rates came down and they went up. Now, obviously, this will be a slightly more truncated time scale because they may only come down for a year or so and then they go back up again. But the overall thesis is correct. I think the reality is that the Federal Reserve and other central banks went a bit bananas with their raising of rates. And, probably if they'd been a bit more measured about the whole thing, we would be in a situation where they'd got to a level, they'd been stable for some time. And then when things started to really slow down, I think they would start reducing them, and probably it'd be too late by then. I suspect some of this is a little bit kind of motivated by wanting to be nice to the next president, maybe a new person. And, and we've seen this in the UK. As soon as the new government's in place, there's an interest rate cut. I mean, it might precede the election, but there'll be probably a few cuts after the election as well. And that, it gets things going in a way that's very helpful and so on. I mean, people talk about central bank independence, but they are ultimately political creatures and they have to be aware of the politics. So I think your overall observation is correct. I just think the timing there'll be a bit of timing that kind of finesses the forecast, and crucially, that timing is related to where we are in the real estate cycle.